Hey everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week. We talk all things housing, seeing what's going on in the market and seeing what's going to happen in the future. So today we're going to talk about Hurricane Michael devastation, I guess interest rates topping 5%, the question of whether we are in a housing bubble or not, the best housing value locations across the country, and we're going to review the updated foreclosure statistics. So let's get started. Now, first of all, thoughts and prayers to all the people affected by Hurricane Michael. We here in the Tampa area got some rain bands and some wind, but it was virtually nothing in comparison to what hit the Florida Panhandle. And realize that this was a very, very powerful Category 4 storm. It was literally 2 miles per hour shy of being classified as a Category 5 storm, which is the strongest category in that storm rating system. So only 2 fatalities have been reported so far, which is unfortunate to hear, but very good news as far as the number of fatalities. Let's hope that's all there is. Roughly 700,000 people are without power now in the Florida, Alabama, and Georgia locations, and rough early preliminary estimates of damage is about $20 billion to the area. Reason being, clearly, winds coming across, 140, 150 miles an hour, is going to take care of a lot of damage there. Trees, roofs, buildings, etc. Also, there was a significant storm surge, about 15 feet in some locations, and I was watching news reports of news guys showing the water being pushed inland up the rivers. It was moving in so fast you wouldn't believe it. All the beach roads were under 6-7 feet of water, depositing sand, the whole bit. So it's quite the mess there. They're going to go through a lot of pain and agony to get the cleanup going and stuff like that. So hundreds of flights are canceled throughout Florida, Georgia, the Carolinas. I know Charlotte had about 300 flights canceled today. And the reason being, their storm system is still working through there. And it's a lot of high winds, a lot of rain. So basically, it's putting the kibosh on people traveling, which is understandable. Now, some good news: Freddie Mac already stated that to mortgage servicers to offer immediate forbearance relief to the people who have home mortgages in the affected areas. Now, this is a great thing. It allows you to not pay your mortgage for a period of time. I guess they're offering up to 12 months worth of forbearance. And during your forbearance period, there's no negative credit reporting, and there are no late fees, penalties, and things like that. That's the good news. On the flip side is that once your forbearance period is over, they require you to pay back what you didn't pay in a lump sum. That does cause people a lot of problems, and then things will get a little more difficult. So it's helpful, but again, you still owe your money at the very end. And unfortunately, what we're going to see is most people will be in a situation where they haven't been able to save the funds to pay. They don't have access to the funds or just enough money in savings. Also, if you work for a local company or your local employment, maybe they're not earning and they can't pay you as well too. So it's like a domino effect here. So unfortunately, a lot of people who get hit in the immediate area of the hurricanes and suffer the most, end up having some major issues with respect to their homes because they don't have the cash or funds to pay the mortgages once it's all over with. So we'll just keep an eye on that. And again, this is something that we'll see affect the marketplace, 6 months, 12 months plus down the road here. So again, we wish everybody up in those areas well and hope for a speedy recovery. I know that there's a lot of pre-planning and disaster relief that was set up, and they're probably mobilized right now. FEMA workers, food, water, shelters, a lot of people who work for power companies are en route to go to those locations and support the devastation. So that's great news. Interest rates topping 5%. So mortgage interest rates have finally hit over 5% this past week. Now, it's the highest interest rate for a mortgage since January of 2010. So that's 8 years, almost 8 years ago, or more than 8 years ago, actually. So there you go. Now, obviously, when rates increase, mortgage application volume falls. It fell 1.7% for this week, and the mortgage application volume is 15% lower compared to a year ago. Now, that's on home purchases. On refinances, the volume fell 3% of refinance applications this week and is 32% lower compared to this time last year. So clearly, people who are looking to refi, cash out some equity in their home are not thinking they want to pay these high rates are going to hang on before they trigger that. So that just seems to make sense. Now, when this stuff happens, when mortgage rates go up, unfortunately, more home buyers turn to riskier loans, i.e. adjustable rate mortgages, otherwise known as ARMs. So the ARM share of mortgages that have been originated since the end of August has risen to 7.3% of mortgages from 6.1% just since August. So right away there, you want to get into a house. You don't want to pay your fixed rate mortgage of almost 5% for 30 years. So you're going to roll the dice and tempt yourself with cheaper entry level, knowing that things are going to reset down the road. You're going to hope that interest rates either don't go up too high or your property gains in value to offset any increase, etc. So again, just more ways to get people to purchase homes, which I think is definitely risky. Clearly, there's more mortgage fraud going on right now, and what I mean by mortgage fraud, it's mortgage application fraud. Like there's a lot of people who are, I guess you could say, fudging their numbers and incorrectly stating their income and things like that in order to get a mortgage. So we find that when rates rise and house values rise, that all starts to increase in activity as well too. Now remember, the Feds, Fannie Mae and Freddie Mac, are endorsing 3% down mortgages. So and according to a recent survey by Fannie Mae, more people think rates will continue to go up. And yes, this is true. The Fed has stated they will raise rates in December, and there will be at least 2 more rate increases in 2019. That's what they've stated. So this puts pressure on buyers to buy a home, and obviously, as I mentioned, that they're going to go down the path of either finding loan programs that suit their situation today and not really think about how it's going to affect them in the future, which is kind of what happened with our last housing bubble and housing crash and crisis. So again, a lot of things that happened back then are happening right now, and we're choosing to ignore them. Now, which puts us to the question, leads us up to, are we in a housing bubble, housing crisis? Who do you believe? What's going on? Well, I think if you take a look at the internet and you read news sites and news articles from reputable sources, a lot of the economists out there are saying the market, their word is frothy, and a lot of metro locations are bubbling or in a bubble territory. So you can take a look at the Case-Shiller Home Price Index. The sort of the main one that you take a look at is 11.2% at last count above the 2006 peak value. So again, a lot of locations have increased in price, have lost, and have increased and gained more. So you could say we're in a bubble. Most of the major metro locations are in a bubble. There are still pockets around the country that haven't quite hit recovery yet, and there still are pockets around the country that have a fair amount of homes that are actually underwater. So they have negative equity, believe it or not. So it's difficult to determine what's going on, but I think the general sentiment from economists, industry analysts, from different investment houses, groups, etc., are saying that, hey, we are in a housing bubble. So the housing bubble's here. We're at peak, the stage 2, which is the peak. So we've peaked, and what happens after the peak? You start to slide, and you start to move faster and accelerate. And we've seen more inventory come on the market. We've seen price reductions. So that's happening right now. Unfortunately, we can't see the net effect of price reductions in inventory until a couple months down the road, when stuff transacts. Stuff that's put on now transacts, then we'll be able to see a bit more. So right now, we're in this, what I call this dangerous transition period, where if you're looking to buy a property or invest, you really don't know what to do, and you probably have a lot of questions. Now, going to a mortgage broker, a mortgage professional, I find when I look at all the videos online, most mortgage professionals feel that we are not in a housing bubble or facing a housing crisis, and that things are going to go well and are going to further increase and appreciate next year. And their baseline reasoning for this, at least the number that I have seen online, tends to be the fact that there's more qualified borrowers that are in the market. So they go back to the last housing crisis and saying we were giving loans away to anybody with a pulse. They were unqualified. Now we have better standards and guidelines, etc. Well, that's just great. Well, you know, guess what? We have more non-banks out there right now originating loans. We have the emergence of subprime called non-prime hitting the market now at its peak. We have adjustable rate mortgages coming back in fashion now because people need them to get into housing, and the government is supporting a 3% down. So again, if I'm a home buyer and I've put 3% down and I've got a 5% interest rate, you know, so I've got a fairly high mortgage payment, all the market has to do is drop 5% and I'm underwater because I can't sell it without closing costs and commissions for 5% or less. It's going to be a lot more than that. So right away I'm underwater. I'm underwater when I bought the property. So again, buying and having high interest, low down payment mortgages, which is the way they're combating the high housing costs, is to give you more financing, really puts you in a position of any subtle market shift throws you negative in your equity, and you know that's not a good thing. So just realize that's what I'm finding. So personally, we're in a bubble. Yes, there are locations. Your metro may not be quite affected, or maybe have had the biggest delta, but it's happening. It will work its way. A lot of locations are experiencing corrections right now. It usually starts with the mega cities and works their way down. That's typically how it happens. So again, some people still predict an increase in value, and it's still too early to see where that's going to go. But you know, we're back to the whole point going, if you know, more inventory should alleviate some of the stress, and as people realize that we've peaked, they will get their properties out there and in order to cash out and get what they've made over the past few years. So we're going to see some interesting times over the next few months here. So again, those changes won't be a statistic till later on. And you know, sentiment also, people think prospective buyers are better off renting, all right, instead of buying, and yet half the American renters struggle with unaffordable housing costs. So even though home prices are too high, if you choose to rent, you're facing high rental prices now too, because both tend to drag each other along. So it's a vicious cycle as far as I'm concerned. And you know, you can't or won't buy due to the high prices and costs, but you're still going to pay a lot in rent. But in the end, if you think about it, if you're looking to purchase a house right now and you're getting kind of, you know, nervous and you don't feel comfortable with it, why not rent? Because you know, the owner of the house has to pay taxes, has to pay insurance, has to deal with repair issues and putting new roofs on. And if there's natural disasters, it's, you know, they're fixing it and it's not coming out of your pocket, so to speak. So you know, that's and their value and their financing. So that's their issues. You can, you know, leave anytime you want, basically, out of your lease or month to month, whatever you're doing. So you have more fluidity as a renter, and then you can pick and choose sort of, you know, when you want to strike and buy. Some people are having buyer remorse, thinking they bought at the height, and they're now listing their home, putting their home back in the market, going, I bought it at the height and I don't think I can cash out, or I'm nervous, I may never cash out, I want to put it back out in the market and get my money back out and go someplace else. So we have a lot of that. So basically they're trying to unload before there's a big drop in the market, and this was sort of the statement according to Redfin out there. So basically, who do you listen to? Who do you believe? It's a tough call out there. For me, it's become educated. Listen to a lot of people. Try to find out what's making sense. For me, I listen, I learn, I look at statistics. I have personally been through the last housing crisis, so I was active from a lot of different perspectives. During the last housing crisis, I saw it gain, I saw it plateau, I saw it crash, and I saw it recover. So I'm pretty confident in where I see things going. And again, if you're looking to what happened over a decade ago, virtually all the signs are here right now. And you know, there's some nuances and some variations, but pretty much what caused it, people are doing the same thing now, and nobody seems to care. So as far as I'm concerned, we're moving to that direction. So we're bubbling in most markets, and we'll see, the rest will pick up. So anyway, insulate yourself as best as possible. Look for deals, look for value, look to purchase as it slides down, whether you're buying for an investment or buying as a primary residence. You know, clearly, you know, if you have time, wait it out, or negotiate hard, or don't be afraid to put lower offers in and negotiate. Remember, once you put an offer in, it's tougher to reduce your price than to raise your price. So go in aggressive and see where the buyer cries the seller cries uncle. It's the best you can do at this point in time. Go after financially distressed properties. I mean, do you have to buy the most beautiful rehab, great looking property on the block? Maybe if you step back and buy something a little distressed, you're going to get more value for your money. It was certainly proven that people who purchased foreclosed homes back after the last housing crisis have actually earned the most appreciation from where they were back then to where they are today, because they were buying at such a discount. So if you can afford to wait and you can play that game, good for you, whether it's investment or whether it's your own primary residence. So there you go. I look at, again, not that many REOs available, but I would look at the pre-foreclosure market where you could probably get the best discounts right now. So the St. Louis Fed released a report recently in October here that analyzed which major metro offers the best housing value. I look at that as being a bang for a buck on the basis of the analysis was long-term changes to average house price or rents versus compared to personal incomes to gauge which locations had attractiveness for buyers. So basically, and they had some other factors in there like amenities and locations and things like that. But again, it was really based on your money going farther when you're buying a house or renting. And it was found that most of the metros that had the highest values were in the upper Midwest. They had the best values, and the major coastal areas had the least values, believe it or not. So Detroit led the way with as best value to live or house pricing, followed by Cleveland, Cincinnati, Indianapolis, Chicago, and Columbus. So you've kind of got that pocket of upper Midwest right there that really is good value. The least value locations were Miami, New York City, Baltimore, LA, Seattle, San Diego, and Tampa. And obviously, the higher the value, the cheaper the price was. So you got more bang for your buck, and there's just more flexibility in buying or renting in those locations. Now, it's up to you whether you choose to live in Detroit versus San Diego or Miami. That's a personal choice. So clearly, there's benefits to different locations, but it boils down to, you're going to pay a premium for those benefits. So if you're looking for strict value, if you're making the same amount of money, regardless of where you live in the country, and you want to go for value, go to the upper Midwest. And again, you can find this report on the St. Louis Fed's website. It's right there. Okay, updated foreclosure statistics. Atom Data releases Q3 foreclosure activity report, and it was found that Q3 had a 6% drop in foreclosure activity when compared to the previous quarter, Q2. And this was the lowest level of activity since Q4 of 2005, which is well over 10 years. So guess what? That's a good thing as far as distressed housing goes. But if we go back a couple of videos that I released and we take a look at some of the monthly data, because Atom Data also puts up monthly foreclosure reports, I recall talking about, maybe I think it was July, where we saw that 45% of major metro locations actually had an increase in filings. So, it's this is a tough statistic to look at. I don't tend to look at this on a quarterly or annual basis. I look at it on a monthly level because there are nuances on when and how foreclosures are filed. I know that certain months and certain times of the year they pick up their pace in funds, and some months that they actually gear down. So for me, I like to trend it out over a longer period of time. But again, realize that having the lowest drop in a quarter, within that quarter we saw highest hits, in number of years on foreclosure filings for a number of locations. So it can be misleading and confusing. Counter to that national trend, 15 states posted year-over-year increases in foreclosure filings and activity. 79 metros did as well. And I know personally that foreclosure filings have picked up in various I know what's going on in my own state here, and other people I talk to in other states across the country, they're saying that they see it, they see the volume, they see the filings. Now, whether those filings are coming out as housing opportunities is not, is yet to be determined, but people are still feeling the heat on personal economy in different locations across the country. Now, Michigan as a state was up 32%, Florida 25%, Maryland 13%, Missouri 10%, and Texas up 3% for the third quarter. All right, so basically we'll look to see what happens on a monthly basis as opposed to a quarter. We will definitely see probably an uptick for September numbers, October numbers, just because I do believe that's traditionally, historically, when it picks up again from what I remember seeing and look at over all the years I've been analyzing this. Realize that once Thanksgiving hits, the filings and activities do slow down. The reason being the federal government doesn't like to foreclose or cause people stress over the holiday season. They tend to discourage that. They'll actually make a statement usually saying we're not going to do any repossessions over December or 2 or 3 weeks over the Christmas holidays. And A lot of the lenders tend to follow suit as well too, which is kind of nice. However, once January hits, guess what? You see those foreclosure activity, foreclosure filings and repossession numbers spike up really quick. All right, so again, it slows down, but it picks up. So we see a lot of this going on and with respect to the foreclosure activity. So that's the scoop there. So again, I still believe that this is a market that's not touched and very available to us. There's more to talk about this in the future with respect to the pre-foreclosure market. So again, keep your eye on that as opportunity. So once again, thank you for your comments and all your viewership. I appreciate that. Anyone who wants to learn more about distressed housing, about the pre-foreclosure market, about, or you have questions or thoughts, want to discuss things, drop me a line. My email is randy@luxuryshortsales.com. That's randy@luxuryshortsales.com. I'll make sure I respond to you. I'm getting a lot of questions and a lot of comments. And again, the nice thing about what we try to talk about here is, news. And I've seen some of the comments out there, which I don't take offense to, not a big deal. We all can talk about things. We all have our opinions. What I'm trying to do is provide a summary of news in the housing industry and give my own opinion. Your opinion can vary from mine. If you look at the comments, though, I think that's where you see where people are trending and their belief of the housing market, and really time will tell. I mean, again, we're kind of, as I said, in this transition period right now where, we all feel that something's going to happen, but we're not too sure yet, and statistics aren't quite there to back us up because we're going through that change right now. So we're at this really weird transition time. So just think about that. And again, what happened yesterday? I mean, the Dow took, or whatever, the stock markets took a big dump yesterday, and it's usually not one thing that starts a financial crisis. It's usually multiple things in combination. So that's where we're at today. I'm not a stock guy, I'm not a financial analyst, so I can't comment on that. But again, just be aware what's out there, make good decisions with your real estate, and we'll look forward to talking to you guys next week.